88%. I mean, just think about that number for a second. That is the operating margin on Fair Isaac Corporation's core software business.
Yeah, it really is a number that, well, it almost defies the laws of gravity and capitalism, honestly.
Right, because in any normally functioning market, an 88% margin acts like blood in the water.
Oh, absolutely.
It should immediately attract this, massive swarm of well-funded disruptors who are just determined to undercut your pricing.
They want to steal that market share and compress that margin down to something normal.
Exactly, something rational. Yet for decades, nobody has been able to lay a finger on them. So today, we're doing a deep dive into a huge stack of equity research, earnings transcripts, and competitive analysis.
We want to find out exactly how these three global data behemoths, Fair Isaac, which, everyone calls FICO, Equifax, and TransUnion, how they actually extract cash from the economy.
And when you see a number like 88%, it forces you to completely rethink what a structural competitive advantage actually looks like in the real world.
It really does. Because the financial press, they just love to focus on the noise, don't they?
Oh, always. The quarterly earnings beats, the shifting interest rates, all of it.
Right, or like the latest product announcement. But when you strip all of that away and you just look at the raw business economics, you realize this is fundamentally a study in the architecture of modern financial plumbing.
Yeah, that's a great way to put it. We're looking at three distinct models of monetizing trust and identity.
And our goal today, just to be clear, is not to try and guess which stock is going to bounce 5% next week.
Right. I want to set the ground rules for how we're approaching this deep dive right up front. Think of this as a working session between two very disciplined, very patient investors.
We are not offering stock tips here.
No financial advice at all. Do not take anything we discuss here as a cue to go, rebalance your retirement portfolio.
Please don't do that.
We're applying a very specific Buffett-style lens to the research we have in front of us. We are looking strictly at durable business economics.
When we talk about long-term investment quality, we're talking about sustained returns on invested capital that persistently, year after year, exceed the company's cost of capital.
Exactly. We want to know what happens to their cash flows when the macroeconomic environment gets incredibly ugly.
That requirement for resilience, that is the filter that eliminates probably 90% of companies from consideration right off the bat.
I look at it kind of like evaluating ships for an Arctic expedition.
Okay, I like that.
Any company can look like this beautifully engineered speedboat when the macroeconomic waters are smooth, right? Capital is cheap, everything is great.
But a speedboat just shatters the moment it hits thick ice.
Exactly. We're looking for the icebreaker ship. We want to know how the hull holds up when inflation spikes, or, when lending completely freezes, or regulators start breathing down their necks about data privacy.
To find that true compounder, you need a specific architecture. You need resilient revenues that don't just evaporate when lending standards tighten.
And you need a real reinvestment runway.
Right, meaning the business actually has a logical high-return destination for the cash it generates, not just piling it up or blowing it on some low-yield acquisition.
You have to look at the operational discipline of the management team, but at the absolute center of it all, we are looking for a structural moat.
Not just a nice brand name, a physical or economic barrier that literally stops a competitor from copying the model.
So to ground this, I want you, the listener, to put yourself in a highly constrained scenario today.
This is a great thought experiment.
Imagine you are a partner allocating capital for a private investment firm. You're sitting across the boardroom table, and you are forced to put your capital into one of these three business models: FICO, Equifax, or TransUnion.
But the cat, and this is the important part, is a 20-year lockup.
Yes. Once you buy the asset, you cannot sell it until the year 2046. You are entirely stripped of the psychological crutch of liquidity.
Which completely changes your entire analytical framework. Because if you can't sell, well, you suddenly stop caring about whether the Fed cuts rates by 25 basis points next Tuesday.
You stop caring about PE multiple expansion.
Right. The only thing that matters is the structural integrity of the cash-generating mechanism. Which one degrades the most gracefully under severe stress?
So to figure out which of these three is the true icebreaker, we really have to start at the bedrock. We have to look at their fundamental economic engines. How are they actually making money?
Let's start with FICO, because their engine is just a total anomaly in this group.
It really is. They are the smallest of the three by top-line revenue. They generated roughly $2 billion in fiscal year 2025.
growing at about 16% year over year,
Hmm.
which is solid. But size is super deceptive here.
Very deceptive. Because FICO is not a data aggregator.
No, they don't maintain these massive capital-intensive server farms filled with your raw credit history.
The credit bureaus Equifax and TransUnion, they have to bear all the cost of acquiring, storing, and securing that raw data.
FICO is a pure-play analytics and software model. They just supply the math.
FICO is the boutique refinery, right? And the bureaus are the sprawling, dirty mines.
That's a perfect analogy. Equifax and TransUnion are spending billions to pull the raw ore of consumer data out of the ground.
They clean it, they store it, they protect it.
And FICO just sits at the very end of the supply chain. They take that raw ore, run it through their proprietary algorithms, and turn it into a standardized, usable number for the banks.
And because they are just selling the algorithm, their revenue profile is so different, it basically operates like a royalty model.
Exactly. 88% of their highest margin scores revenue comes in as royalties from the data providers.
And when you think about the economics of a royalty model, it's just staggering.
Because you absorb the R&D cost to build the algorithm once.
Right. You pay the data scientists to make the model.
And after that, every single time a bank or a mortgage originator queries a credit bureau for a FICO score, FICO extracts a tiny toll.
And the incremental cost to FICO to deliver the 10 millionth score is effectively zero.
Zero, which is exactly how you arrive at that insane 42% operating margin on their consolidated business. For every dollar that comes in the door, 42 cents falls straight to the operating line.
But what really stood out in the deep dive research is how they're trying to diversify that royalty stream, because they're pushing super hard into what they call the FICO platform.
Yeah, they are moving way beyond just the basic credit score and into enterprise cloud software.
It's a classic B2B SaaS, land and expand motion.
The credit score is the wedge. Because every major bank is already totally tethered to FICO for loan origination, FICO uses that relationship to cross-sell cloud analytics.
They land the account with the API for the score, and then they're like, hey, buy our fraud detection module too.
Or our customer lifecycle management software.
Mm-hmm.
And their software annual recurring revenue, their ARR, is sitting at about $264 million right now.
Which is roughly 35% of their total software revenue.
Right. And this platform model makes the revenue incredibly sticky.
Oh yeah, once a bank embeds your fraud detection algorithm into their daily transaction processing, ripping it out is a multi-year IT nightmare.
Nobody wants to touch it. So FICO has this pure play, high-margin software engine. But now let's look at Equifax.
Right. Equifax is the largest of the three by a pretty wide margin. They are pulling in just north of $6 billion in revenue for 2025.
But to really evaluate Equifax, you have to understand that you are basically looking at two completely different economic engines operating under one corporate roof.
You really have to split that $6 billion in half to see how it works.
Exactly. On one side, you have the USIS segment, the United States Information Solutions.
That's the legacy credit bureau we all know.
Right. It's the infrastructure providing data for mortgages, auto loans, credit cards. USIS is about 34% of Equifax's total revenue, and it operates at roughly a 23% margin.
But the defining feature of USIS is extreme cyclicality. It is entirely volume-based.
If mortgage rates climb to 7 or 8%, refinance activity just completely collapses. Existing home sales plummet.
And when banks stop originating mortgages, they stop pulling Equifax credit files. It's that simple. Equifax cannot force banks to lend money.
They are completely at the mercy of the macroeconomic lending cycle. That is the massive vulnerability of the legacy bureau model.
But then you look at the other side of the house, Equifax Workforce Solutions, or EWS.
This is the absolute crown jewel of their portfolio.
It's built on a proprietary database they call the Work Number, right? Which is basically this massive centralized repository of payroll data.
Think about the old way. When you applied for a mortgage, the underwriter had to literally call your HR department to verify your income.
They'd be faxing W-2s, waiting days for someone to get back to them.
Equifax automated that entire workflow. They integrated APIs directly into the payroll systems of the biggest employers like ADP, Workday, places like that.
So now the underwriter hits verify, the API pings the Equifax database, and the income verification is there instantly.
And underwriters are thrilled to pay a premium for that because it cuts down the time to close a loan drastically.
That reduction in friction is exactly why Workforce Solutions commands an operating margin of around 45%.
And why it makes up over 42% of their total revenue now.
But the truly hidden brilliance of EWS is its counter-cyclical dynamic.
This is crucial. During an economic boom, lending is high, and EWS makes money verifying income for new mortgages.
Right. But what happens in severe recession? Unemployment spikes, lending volume crashes. The USIS segment takes a huge hit.
However, millions of people start applying for unemployment benefits, or Medicaid, or housing assistance.
And every single one of those government agencies has to verify past employment and current income to process those claims.
Exactly. EWS monetizes all those government verification queries. It provides this vital structural hedge that really dampens the volatility of Equifax's overall cash flow.
It's a great hedge. But even with that incredible EWS engine, Equifax's consolidated operating margin in 2025 is still sitting around 18%.
Which is less than half of FICO's 42%.
And the reason comes right back to the architecture. FICO is asset light. They host the code. Equifax is wildly capital intensive.
They have to operate these massive physical data centers all over the world.
They employ armies of compliance officers just to navigate global privacy laws.
And they are dumping hundreds of millions of dollars continuously into cybersecurity to protect the data of, 800 million consumers.
Those are all fixed costs. Whether Equifax sells one credit file or 10 million, the cost to run the servers and the security team is basically the same.
And that heavy fixed cost base gives them huge operating leverage on the way up, but man, it causes severe margin compression on the way down.
Which perfectly leads us to TransUnion. They are sitting squarely in the middle with about $4.5 billion in revenue.
If FICO is the software refinery and Equifax is the dual engine mine, TransUnion is trying to build this weird hybrid approach.
They obviously have the legacy USIS-style bureau, but their strategic engine is pointed in a completely different direction.
They're actively trying to escape the gravitational pull of the consumer credit cycle.
Because they see how volatile it is to rely on mortgages, so they take their core identity resolution capability, they call it the True Picture database, and they push it aggressively into non-traditional verticals.
Like healthcare, insurance, the public sector.
The mechanics here are fascinating. In healthcare, a hospital uses TransUnion data not to give a loan, but to verify identity to stop medical fraud.
Or to predict a patient's ability to pay out-of-pocket costs, which optimizes their billing cycle.
Right. In insurance, they use trended credit data to build better auto insurance underwriting models.
By diversifying who uses the data, TransUnion is actively smoothing out their revenue curve. If the housing market totally freezes, well, hospitals are still admitting patients.
Auto insurers are still writing policies.
It's a really smart attempt to decouple themselves from the pure financial macro cycle. And it's working. Their emerging verticals are seeing mid-teens growth.
So we have these three distinct engines. FICO's asset-light royalty model, Equifax balancing cyclical credit with counter-cyclical payroll, and TransUnion's diversified identity model.
So let's run our stress test here. Let's see what happens when the ice gets incredibly thick.
Let's do it. We enter a prolonged, ugly, stagflationary environment. Interest rates are stuck at 8%, credit demand craters, and lending completely freezes. What physically happens to the cash generation here?
Well, Equifax's 18% margin faces immediate brutal compression because of those fixed costs. If USIS revenue drops 20%, they can't just lay off 20% of their compliance team or shut down a fifth of their servers.
Right. Those costs eat up the shrinking revenue, and cash generation just plummets.
Now, you might ask, wouldn't FICO suffer the exact same top-line hit? If mortgages drop, the bureaus aren't pulling FICO scores, so the royalties dry up.
That's my thought exactly. Don't they get hit just as hard?
Their top-line revenue growth would absolutely slow down. It might drop from 16% to flat. But this is where that 42% margin fundamentally alters the physics of the business.
How so?
Even if FICO suffers severe margin compression, say they drop to a 30% margin, they are still converting massive amounts of revenue into free cash flow. They don't have physical infrastructure dragging them underwater.
Their baseline profitability is basically a giant operational shock absorber.
Exactly.
Okay, let me push back on FICO's model for a second, though, because when you just look at the numbers, it seems invincible. but their footprint is extraordinarily narrow.
It is very narrow.
Equifax and TransUnion have this huge horizontal optionality. Because they own the actual raw material, the data, they can wake up tomorrow and repackage it into a healthcare product or a marketing tool.
Right.
FICO is a vertical toll booth. They are entirely dependent on banks continuing to rely on their one specific algorithm. If I'm putting all my capital into a single toll booth for 20 years, I better be damn sure nobody can build a bypass road around it.
And that is the exact trade-off we have to weigh. Predictability versus optionality. Equifax and TransUnion have immense optionality, but lower predictability. FICO has massive predictability, but zero optionality if that score becomes obsolete.
Which means we need to pivot from looking at the engines to examining the structural integrity of their moats. What is actually stopping a competitor from unseating them?
Let's dissect FICO's moat first, because honestly, on paper, it looks terrifyingly fragile.
It really does. 51% of FICO's entire 2025 revenue came from just 3 contracts.
Equifax, TransUnion, Experian.
In any standard business analysis, a 51% customer concentration among 3 clients is a massive blinking red flag.
Usually that means that customers hold all the pricing power. You would assume those 3 bureaus would just get together, form a consortium, pool their data scientists, build their own algorithm, and completely cut FICO out of the loop.
Why keep paying the toll if you own the highway?
Exactly. And the fascinating thing is they actually tried to do exactly that.
Right. They launched VantageScore to compete directly with FICO.
But VantageScore completely failed to displace FICO as the industry standard. And the reason it failed tells you everything you need to know about FICO's moat.
It's not just a technological advantage, it's a structural, quasi-regulatory monopoly embedded in the plumbing of the secondary mortgage market.
The secondary market mechanics are the whole game here.
Mm.
When a retail bank originates a mortgage, they almost never hold that 30-year loan on their own books.
Right, they sell it to the government-sponsored enterprises, Fannie Mae and Freddie Mac.
And Fannie and Freddie have very strict underwriting standards for what they are willing to buy and securitize. Until very recently, they literally mandated the use of classic FICO.
It was written directly into the regulatory guidelines. You
Really?
literally could not sell a mortgage to the government unless it had a FICO score attached to it.
So it doesn't matter if VantageScore builds a mathematically superior algorithm. If the secondary market won't buy the loan, the originating banks will never use it.
But the research we're looking at indicates that mandate is actually evolving right now. The Federal Housing Finance Agency, the FHFA, recently announced a transition to allow newer models.
Right. They specifically endorsed FICO 10T and VantageScore 4.0.
So doesn't that regulatory shift finally break FICO's monopoly?
You'd think so. It introduces theoretical competition. But the practical execution actually reinforces FICO's dominance.
How's that work?
Let's look at the mechanics. Older FICO models use snapshot data. They looked at your credit utilization at one single moment in time.
So if I maxed out my cards for a year but paid them off the day before I applied for a mortgage, the snapshot made me look like a prime borrower.
Exactly. But FICO 10T uses trended data. It looks at the trajectory of your behavior over 24 months. Are you paying down principal or just masking debt?
Which requires massively more compute power and fundamentally changes how a bank models risk.
Precisely. And the banking industry has spent 40 years calibrating their internal risk models, their capital reserves, their pricing algorithms, all to the FICO standard.
So transitioning away from FICO is a logistical nightmare for a bank.
The FHFA endorsement essentially ensures that as banks are forced to upgrade to trended data, they are just going to stick with the FICO ecosystem to maintain continuity.
The switching costs for the entire global financial system are just way too high. That is a truly structural moat.
Now, contrast that with Equifax. The research calls Equifax's advantage a data plus workflow moat.
We talked about those API integrations with workforce solutions. Once a property management software integrates that income verification API, they aren't ripping it out. The switching costs are real.
Yes, but the raw asset itself, the actual consumer data, is incredibly fragile.
Because it's constantly under siege. The 2017 Equifax data breach is the defining event here.
Exposing the personal data of nearly 150 million Americans wasn't just a bad PR day. It fundamentally altered their regulatory reality forever.
They operate under a permanent cloud of scrutiny from the Consumer Financial Protection Bureau, the CFPB.
They are forced to operate under these strict consent decrees. They have to spend hundreds of millions overhauling their cybersecurity architecture.
This highlights the difference between a structural advantage and an execution advantage. FICO's advantage is structural inertia. Equifax and TransUnion rely on execution.
They have to continuously execute complex data ingestion, constantly patch their firewalls, and navigate an evolving maze of privacy laws.
If an Equifax employee misconfigures one server, regulators will impose massive punitive fines.
And TransUnion is fighting that same execution battle, but they have different historical baggage dragging them down.
Yeah, TransUnion's history really shapes its current moat. For years, they were owned by private equity, specifically Towerbrook Capital Partners.
And the standard private equity playbook usually involves loading the balance sheet with debt and aggressively squeezing out near-term cash flow.
Often at the expense of long-term tech investments. So when TransUnion finally re-entered the public markets, they were operating with massive technical debt compared to Equifax or Experian.
They've had to play desperate catch-up, spending billions on M&A, like buying Neustar, just to build out that true picture identity tech.
They're heavily patenting AI models for fraud detection just to get an edge. But it's trench warfare. They are fighting for an identity match rate that's maybe 0.5% better than Equifax's.
It is grueling, capital-intensive execution.
Let's run a quick thought experiment here to crystallize this. Say I give you $1 billion in unrestricted venture capital. Your only job is to destroy the core business of one of these companies. Where do you aim the money?
If I target FICO with $1 billion, I fail. Almost certainly.
Really? $1 billion wouldn't do it.
No. I could hire the 1,000 smartest data scientists on Earth. I could build an AI algorithm that predicts defaults twice as accurately as FICO 10T. I could literally give it to the banks for free.
And it wouldn't matter.
It wouldn't matter at all.
Yeah.
Because you cannot change the FHFA securitization guidelines with $1 billion. The structural barriers make superior tech largely irrelevant.
But if I take that same $1 billion and target Equifax, I think I have a real path.
Oh, absolutely.
I could build a pristine, cryptographically secure income verification database from scratch. I could offer massive financial kickbacks to ADP and Workday to break their exclusive contracts with Equifax.
You could market to employers saying, hey, we are the modern, secure alternative to the legacy bureau that leaked half the country's Social Security numbers.
I could actually erode their moat through aggressive execution.
That perfectly illustrates why FICO's structural moat is superior. But there's a massive systemic risk to the data broker model we have to stress test here.
Okay, what is it?
What happens if the U.S. adopts a regulatory framework similar to Europe's GDPR, but strictly focused on financial data?
What if a federal law mandates explicit recurring consumer opt-in for anyone to share or monetize your credit and payroll data?
That is an existential threat to Equifax and TransUnion. They operate on the presumption of passive data harvesting.
If they suddenly have to spend billions marketing to consumers just to beg for legal consent to hold their data, I mean, their database sizes would shrink drastically. Match rates would plummet. Margins would just collapse under the compliance weight.
But look at FICO in that scenario. As an algorithmic layer, FICO is heavily insulated.
Because they don't hold the toxic asset.
Right. They don't hold the unconsented consumer data. If the bureaus have degraded data, maybe the predictive power of the FICO score drops a little, but FICO is insulated from the primary regulatory blast radius.
So if we just pause our analysis right here, the conclusion seems blindingly obvious.
It does.
FICO possesses a sauce engine generating 42% margins, protected by an unbreakable regulatory moat, and they are immune to consumer privacy legislation. Case closed. It's the ultimate 20-year compounder.
If the analysis stopped at the operational level, FICO would be the undisputed champion. But a pristine business model can be severely compromised by how the management team engineers the balance sheet and allocates the cash flows.
This is where the narrative takes a really sharp turn.
When we examine capital allocation, the entire dynamic flips upside down. The company with the weakest moat and the cyclical engine suddenly looks the most prudent.
And the company with the flawless engine is doing some highly aggressive financial engineering. Let's start with Equifax's capital allocation because I think it shows they deeply understand their own vulnerabilities.
Under CEO Mark Begor, their focus has been intensely directed toward balance sheet resilience. The research really highlights their commitment to cash conversion, targeting a rate greater than 100%.
Cash conversion is such a critical metric for a capital-intensive business. It measures how effectively your accounting earnings are actually translated into liquid cash.
Because Equifax has high depreciation and amortization from their data centers and acquisitions, their accounting net income can look artificially depressed.
But a cash conversion rate above 100% means highly disciplined working capital management. They are turning profits into hard cash rapidly.
And they are deploying that cash with extreme conservatism. Their net leverage ratio, which is total debt minus cash divided by EBITDA, is sitting at a very comfortable 0.66 times.
They are holding roughly $800 million in cash on the balance sheet, and they project over $1 billion in free cash flow by 2026.
Mark Pegor understands that Equifax runs a cyclical USIS business under constant threat of regulatory fines. You simply cannot run a highly leveraged balance sheet when a spike in interest rates can cut your mortgage revenue by 30% overnight.
So they are pacing their share repurchases carefully, about $260 million in the first quarter of 2026, and they just raised their dividend by 12%.
They are managing the company to guarantee they can survive a deep recession without facing a liquidity crisis or issuing dilutive equity.
TransUnion is showing similar discipline, though largely because they're being forced to. We talked about that debt load from their private equity days and M&A phase.
They're currently carrying roughly $4.25 billion in net debt.
But the major catalyst for their current discipline is activist investors, specifically Carl Icahn.
When an activist like Icahn takes a position, the mechanics of management change instantly.
The activist thesis is usually pretty simple: bloated cost structures and inefficient capital allocation.
Icahn's presence applies immense pressure on the board to optimize expenses, aggressively pay down that debt, and maybe divest non-core assets.
It enforces rigid discipline. Management isn't allowed to pursue vanity projects. They are buying back a modest $300 million in stock and focusing entirely on margin expansion.
So Equifax has a fortress balance sheet and TransUnion is under strict activist supervision. And then we look at FICO.
Here is the plot twist. FICO has this flawless operational engine, but management is aggressively leveraging the balance sheet to financialize their returns.
The magnitude of the financial engineering is striking. In fiscal year 2025, FICO repurchased $1.4 billion of their own stock.
And context is everything here. They only generated about $2 billion in total revenue. You cannot fund $1.4 billion in buybacks purely through organic free cash flow on a $2 billion top line.
They are funding these buybacks by issuing debt. The research details that they raised $1.5 billion in senior notes just to finance the buyback program.
And they are doing this in a high interest rate environment. They are taking on expensive debt to buy their own stock. But the most alarming part is the valuation they are paying.
They are repurchasing shares at a price-to-earnings multiple of roughly 38.
Let's mechanically break down why that is so dangerous. It's the concept of negative arbitrage.
Right. If you borrow $1.5 billion at, say, a 5.5% interest rate, you are taking on over $80 million a year in new interest expense.
And if you use that borrowed cash to buy back stock that is trading at a 38 PE multiple, the earnings yield on those acquired shares is roughly 2.6%.
You are literally paying 5.5% to acquire an asset that yields 2.6%.
It only makes mathematical sense if you assume that the underlying earnings of the business will grow at an explosive rate indefinitely, quickly compressing that 38 multiple down to a level where the earnings yield finally surpasses the interest rate on the debt.
Management is making a massive, unhedged, leveraged bet on their own flawless execution and continued macro stability.
And as a result, FICO's net leverage has spiked to roughly 4.7 times their EBITDA.
Taking a company with a 4.7 times leverage ratio into a potentially volatile macroeconomic environment. It introduces a severe element of financial fragility into what was previously an invincible business model.
Financial leverage is a multiplier. On the way up, it amplifies your return on equity. It makes the management team look like absolute geniuses.
But on the way down, it amplifies the pain exponentially.
So let's run the stress test on FICO's balance sheet now. What happens if the execution actually falters? Let's assume the banking sector pushes back hard on the cost of migrating to FICO 10T.
Adoption stalls.
And at the same time, lending volumes contract. So FICO's top-line revenue growth drops from 16% down to 4%.
In that scenario, the market will immediately punish the stock. A company growing at 4% does not command a 38 PE multiple,
The multiple compresses violently, the stock price plummets.
which reveals the real destruction of shareholder value. The $1.4 billion management borrowed to buy shares at peak valuations has effectively evaporated.
But the debt remains. FICO still has to service $3 billion in total debt on a $2 billion business that is no longer growing.
That $80 million in annual interest expense eats directly into those beautiful 42% operating margins. The operational shock absorber we praised earlier is entirely consumed by debt service.
Now compare that vulnerability directly with Equifax under the exact same stress scenario. Yes, Equifax's USIS revenue drops. Yes, their 18% margin compresses.
But because their leverage is only 0.66 times, their interest expense is negligible. They still generate hundreds of millions in free cash flow.
They continue paying their dividend. They might even use their $800 million cash pile to aggressively acquire distressed competitors at fire sale valuations.
Equifax's balance sheet allows them to play offense during a recession. FICO's balance sheet forces them to play defense, dedicating all their cash flow just to surviving.
It presents the ultimate dilemma for the long-term investor. We are looking for the 20-year compounder. Ideally, you want FICO's structural, high-margin business model paired with Equifax's conservative fortress balance sheet.
But the market rarely offers perfection. You are forced to choose your risk vector.
Do you accept the execution risk and regulatory overhang of Equifax's business to gain the safety of their balance sheet? Or do you accept the financial fragility of FICO's leveraged balance sheet to gain access to their unparalleled economic engine?
Synthesizing all of this requires us to really weigh the magnitude of these differences. Where are the disparities vast and where are they incremental?
Well, the disparity in the core economic engines is a chasm. The gap between FICO's 42% margin and Equifax's 18% margin is not a minor inefficiency.
It is a fundamental difference in the physics of how they make money. FICO's B2B SaaS platform allows every incremental dollar of revenue to drop almost entirely to the bottom line.
While Equifax's incremental revenue requires provisioning new servers or hiring compliance staff,
The disparity in the moats is equally vast. FICO possesses a structural monopoly entrenched by secondary market regulations.
Equifax and TransUnion are engaged in perpetual execution warfare, constantly battling regulators, hackers, and each other for data acquisition.
The difference between TransUnion and Equifax, however, is relatively narrow. TransUnion's diversification into healthcare provides some top-line stability, but fundamentally they operate the same capital-intensive brokerage model.
So after dissecting the engines, testing the moats, and scrutinizing the balance sheets, what is the final verdict? If we are that private equity partner locking up our capital until 2046, where is the money going?
Based on a strict evaluation of long-term business economics, FICO emerges as the superior compounding engine.
Even carrying 4.7 times leverage and buying back stock at peak multiples.
Yes. The overarching logic here is that a truly exceptional, structurally protected business model can survive periods of suboptimal capital allocation and financial engineering.
Because FICO generates enough raw cash flow to eventually delever the balance sheet if they absolutely have to.
Exactly. Conversely, brilliant capital allocation cannot fundamentally transform a mediocre, highly regulated, cyclical business into an exceptional one over 20 years.
Equifax's fortress balance sheet protects it, but its 18% margins and regulatory vulnerability heavily cap its upside.
And TransUnion represents a highly respectable, diversified alternative. But they are still encumbered by the capital intensity of the data aggregation model. They simply lack the elite profitability of FICO.
However, the research is explicit that this is not a zero-risk victory for FICO. The conviction level on FICO is marked as moderate.
Moderate conviction is the precise way to look at it. Management's decision to aggressively debt finance share repurchases at high valuations is an unforced error.
It introduces completely avoidable financial fragility into a pristine operational model. It lowers the margin of safety and increases your required rate of return.
The research also outlines a specific macroeconomic scenario that could completely invalidate this ranking and flip the outcome entirely.
Yes. What is the precise combination of variables that makes FICO the loser and Equifax the ultimate winner over the next decade?
It requires a bifurcated macroeconomic environment, a severe, prolonged collapse in credit demand occurring simultaneously with a highly resilient labor market.
Walk through the mechanics of how that breaks FICO but elevates Equifax.
Okay, so if inflation remains sticky and the Fed holds rates high indefinitely, mortgage and auto loan originations remain depressed.
FICO's royalty volumes stagnate.
Right. And because they are carrying that massive debt load, the lack of top-line growth means they cannot outgrow their interest expense, their multiple compresses, and the equity value is punished severely.
But meanwhile, in that exact same scenario, the labor market remains fluid.
Exactly. Even if credit freezes, if companies are still hiring or the gig economy expands, Equifax's Workforce Solutions segment continues to monetize millions of income verification queries.
EWS just prints cash, supporting Equifax's consolidated margins.
Equifax's low leverage means they sail through the credit freeze completely unharmed, while FICO suffocates under its debt service.
In that specific stagflationary environment, Equifax's diversified engine absolutely crushes FICO.
That is the essential mental model to take away from this entire deep dive. Investing is never as simple as just identifying the company with the highest margins.
A world-class business burdened by a heavily leveraged balance sheet will often underperform a mediocre business with a fortress balance sheet if the macro environment hits them exactly wrong.
You cannot simply buy FICO, lock it away, and ignore it. You have to aggressively monitor whether management's financial engineering is stretching them to the breaking point.
You're constantly weighing the structural risk of the business model against the financial risk of the balance sheet.
Exactly.
Before we wrap up today, I want to leave you, the listener, with a final variable to chew on. Something that isn't deeply explored in the immediate financial metrics, but is absolutely critical for a 20-year horizon.
Let's hear it.
We started this conversation marveling at FICO's 88% software margins, and I brought up the concept of blood in the water. Historically, margins that high act as an irresistible magnet for technological disruption.
Capitalism abhors a vacuum, and it equally abhors a permanent toll booth.
FICO's moat relies heavily on the inertia of the banking system and the regulatory mandates of the FHFA. But look at the underlying technology.
FICO is essentially just a massive data processing and statistical correlation engine.
And over the next 20 years, the cost of computing power is trending towards zero. The capabilities of artificial intelligence to ingest massive unstructured data sets and identify predictive risk correlations are expanding exponentially.
Furthermore, you have open banking initiatives like Plaid and the consumer permission data sharing frameworks rolling out globally.
They are fundamentally shifting control of financial data away from the centralized bureaus directly into the hands of consumers.
The existential question for FICO is whether their structural moat can withstand a paradigm shift in data architecture.
Right. If compute costs plummet and open banking allows you to instantly permission your live cash flow data directly to a lender, bypassing the legacy bureaus entirely, does the FICO algorithm lose its relevance?
Will a consortium of aggressive fintech startups figure out a way to originate loans using live, API-driven cash flow underwriting that proves mathematically superior to a lagging FICO score?
And if they do, will they eventually lobby the FHFA successfully enough to rewrite the securitization rules? FICO's math is brilliant today, but math is the easiest thing for AI to commoditize.
It forces you to question whether any structural moat is truly permanent when the underlying technological substrate of the entire industry is shifting.
A regulatory mandate protects you right up until the moment the technology makes the regulation completely obsolete.
That is the long-term risk vector you have to underwrite if you are committing to a 20-year hold.
We started by stating that evaluating these businesses is not like looking at a clean, binary X-ray. It is an exercise in navigating deep, muddy waters.
But by dissecting the mechanics of their economic engines, testing their moats, and exposing the risks in their capital allocation, the architecture really does become clear.
You know what it takes to build an icebreaker, and you know exactly where the hull is most likely to crack under pressure. Maintain that discipline, keep your focus entirely on the durable business economics, and we will see you next time.